Hey everyone, Couch Investor back to another video for today. So we are already in March. Can you believe it? Already now in the third month of the year. It's actually insane how fast time flew this year. Now in this video, we're going to go over the 4 stocks I think might actually interest some of my viewers. I just own one of the 4, so there's no bias here. Of course, do share your thoughts down in the comments below. Maybe if you have other options as well, mention them down in the comments below. Now, of course, March 1st, big day for Tesla investors, and I think the overall market as well. If you missed yesterday's videos, my reaction videos to Farzad's $25,000 car will break the market. Link will be in the top right corner. So in this video, of course, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. So I'll start off with a cybersecurity company, a pretty solid one, which is Palo Alto Networks. I actually never talked about this company on this channel. So Palo Alto Network has a market cap of around $57 billion. Now, as you can clearly see here, over the years, revenue have been increasing steadily. Last 12 months revenue of $6.16 billion, free cash flow positive, and then some in the last 12 months, $2.69 billion. Return on equity right now has turned positive. It's at 8.10%. With regards to gross profit margins, we're close to 70% there. It has a forward PE of 44 times, so not the cheapest, but you're buying here a pretty solid company in a very, very important industry. I don't think that cybersecurity is going anywhere. Actually, I think it's only going to grow from here, as we're going to deal with AI, with machine learnings, as technology just grows and touches everything we do in our day-to-day lives. I think having a solid, good performing cybersecurity company like Palo Alto Network in your portfolio, I think is a no-brainer. Of course, there are other options out there, for example, Fortinet or maybe even CrowdStrike, but of course you'll have to pay a premium. Now, Palo Alto Network actually reported earnings last week. If you want to get a summary of all the earnings report during each earnings season, you can sign up to my free newsletter. You'll get it either Saturday or Sunday in your mailbox. All the links are there as well. It's free, so why not? Link is down in the description and in the pinned comment. So they beat on earnings per share, beat on revenue as well. Q2 non-GAAP earnings per share of $1.05, beat by 27 cents. Revenue of $1.66 billion, which was up 25.7% year over year, beat by $10 million. Now, as for their projections for the third quarter for fiscal 2023, by the way, I've had some comments with regards to, well, it's weird that some companies are already talking about fiscal year 2024. It's normal. Some companies have their fiscal year ending already in Q1 2024. So that's why you have some companies that, well, just follow the normal calendar and others that are already one step ahead. So fiscal third quarter 2023, they expect billings in the range of $2.2 to $2.25 billion, representing year-over-year growth of around 22 to 25%. Now, when it comes to the full year, about the same here. When it comes to growth, 22 to 23% year-over-year growth there. When it comes to revenue, between 25 and 26% year-over-year growth, and adjusted free cash flow margin in the range of 36.5 to 37.5%. Pretty solid. Stock number 2 is Adobe. At the time of making this video, market cap is just below $150 billion. Revenues in the last 12 months, $17.6 billion, have been growing steadily year over year. When it comes to free cash flow, it's a free cash flow machine, $7.40 billion in the last 12 months. Return on equity, very, very impressive there, close to 33% in the last 12 months. Gross profit margin of 87%. PE to growth ratio in the next 12 months, 2.2. Forward PE of just over 21x. Again, it's a very, very solid business. Now, I do want to touch on the acquisition of Figma. Remember, when it was announced, the stock actually crashed, right? We can actually see this. So they announced the acquisition right around here. The stock then crashed close to 18% overall from the day before till the end of the day, 18%. Then went even lower, but we made our way up. Now, recently, what happened here? Again, a crash-ish, let's call it, of 6.5%. Now, why is that? Well, that's because the Justice Department plans a lawsuit to block Adobe's $20 billion Figma acquisition, antitrust issues, etc. So to me, it's a pretty lose-lose situation for Adobe as a stock, right? Because first, they announced the acquisition, which, again, granted, it's a very, very expensive acquisition, but they said it was for them a no-brainer, they called it, but, well, I call it a no-brainer for them because, well, it threatened, let's say, their overall dominance in the market. But they overpaid. $20 billion is extremely expensive. So, okay, the stock crashed 18%. But then that would mean that if this deal gets blocked, the stock should have gone up. But no, it went down another 7%. Well, not another, but it went down 7%. So they really can't win here. But overall, Adobe for the future, I use Adobe Photoshop. I use other programs with regards to Acrobat. Sometimes I use Lightroom. Sometimes even for special effects, I try some things out as well. I have a subscription. I pay every month X amount of dollars. Now, Adobe is let's be honest, a very, very sticky software. Of course, there is DaVinci Resolve as well. I actually use DaVinci Resolve to make the videos most of the times now. Started to learn more about it a couple of weeks ago. So yes, there are some competitors out there. But overall, as we've clearly seen, Adobe is a pretty strong company, fundamentally free cash flow positive by quite a lot, still growing year over year. And I don't think it's going to go anywhere anytime soon, especially not on the downside. So whether or not this acquisition goes through, of course, after what they've said that, well, if they did not acquire, if they're not going to acquire Figma, they are going to be in some sort of trouble, then maybe yes, you can say that it's normal that the market reacts negatively because that means that, well, one of their major competitors will not be acquired by them and we just run loose and maybe somebody else might acquire them and compete directly with Adobe. Could be, but overall, a very, very solid business. Up next, stock number 3 is Wix. We talked about this a long time ago, the website building company, but it's a bit more than that. Yes, it is competing with Shopify and the likes of it. Right now, market cap of $5.33 billion. Revenues in the last 12 months, $1.39 billion. Free cash flow is now negative, but trending a bit better. This is in the last 12 months. If you want to look at actually the quarter, it is now positive again. So pretty good there. There is a reason for that. We're going to touch that in a bit. Return on equity here in the last 12 months is up 723%. That's because, well, the business is fundamentally becoming a bit more profitable since the last 2 quarters because, well, something has changed inside the company. Then with regards to gross profit margin, 62%, fine with me. Forward PE, yes, it's expensive even though it's not really profitable, 62.6 times, so not cheap. But hey, if you're looking for the long term, if you think that can become extremely big, $5.33 billion in market cap in a growing industry might be a good bet, let's say. Of course, do share your thoughts down in the comments below, but this company also reported earnings last week. And they too beat on earnings per share, non-GAAP earnings per share by 51 cents, and revenue grew just 6% year over year, but it beat by $3.12 million. Now, they did say here that they expect full year outlook, so total revenue there, to grow between 9 and 11%. So a acceleration, let's say, overall from this quarter. And they expect total revenue in Q1 2023 to grow 7 to 9%. So let's say another acceleration there. But then when it comes to free cash flow, so they say here free cash flow excluding HQ investments is expected to be roughly $152 to $162 million or 10 to 11% of revenue in 2023. They expect free cash flow margin to improve as they progress through the year and exit 2023 with a free cash flow margin of 12 to 13%, driven by the new efficiencies implemented in the first half of 2023. So again, fundamentally, the business is becoming more profitable. They also had some pressures by an activist that came in and basically made them change the way they operate. And that is also why the stock is up close to 60% since the lows back in June 2022. Now, of course, we've seen this with many high-tech companies. Since the lows, they obviously had to push to become more profitable. Their stock then also rebounded because fundamentally they are becoming, I won't say profitable, but more profitable than before and a bit less cash burning. So that's obviously great and well accepted by the market currently. Now, of course, I already know that some people like to compare Wix and Shopify, which is the better investment there. I think both can make the case for the investment thesis. This is the way it looks right now for both companies. So if you want to watch that, just pause the screen and look at all these numbers. Now let's move on to the last pick. And stock number 4, I don't think it's a surprise to any of you. I've talked about this a couple of days ago, made the case of whether or not it is a buy under $90. Of course, right now with a forward PE of 17.8 times, I mean, a company like this, last 12 months revenue, $282 billion, free cash flow for the quarter, $16 billion, return on equity over 20%, gross profit margin, yes, has come down, but it's still 53.5%. P to growth ratio in the next 12 months of 1.16. I mean, risk reward here, to me, this is a no-brainer. I explained in the last videos and the one before that with regards to Alphabet why. To be honest, it makes sense to take, let's say, a smart bet with regards to this company. If you want to watch, that's going to be in the top right corner. And no, I don't own it in the main portfolio. I only own it in the tiny one, the 4 stocks to rule them all, although now there are only 3. It's basically Nvidia, Microsoft, and Alphabet. You can follow that for free again on StockCard, and you can see why dollar cost averaging works pretty well. For a short amount of time, I was down heavily. It's a portfolio where I basically add $100 each month on the 16th or 15th of the month to all 3 positions, or previously 4th position as well, which was C limited. So for a while, of course, that portfolio was down as most of these stocks took a huge hit. But because I was dollar cost averaging each month, I didn't care what the stock was doing. I knew these were companies I wanted to hold for the long term. So I added each 15th or 16th of the month. And now you can clearly see, I'll post it here on the screen. You can clearly see that I'm in the green and it's actually outperforming the S&P as well. So again, dollar cost averaging in quality companies over the long term is always the best idea. Now, these were the 4 stocks that I wanted to talk about in this video for the month of March. Of course, there are lots of other companies that we could talk about, but I like to focus on 4. Share my thoughts with regards to that. Of course, share your thoughts down in the comments below. And if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.